Good morning. Today's my topic is capital structure. Is another concept of your syllabus related to the fourth unit. There are some practical concept under the third unit which I will engage at the end. So today I am going to explain the theoretical concept of fourth unit, that is about the capital structure. Let me explain about the capital structure. The capital structure is the particular combination of debt and equity used by a company to finance its overall operations and growth. The capital structure, the term is the structure. What it includes, the capital structure, the boundary or the structure or frame of the capital. It includes debt and equity. It is the combination of debt as well as equity. Debt securities and equities. Like equity, ownership securities and debt security. The combination of debt and equity is called as a capital structure, which will help all the operations, or which will plays major role in case of the growth of the company, or in case of the business activities of the company. So that plays major role in case of each and every activities of the company, and the company use that particular capital structure. So they go as per their capital structure. The equity capital arises from ownership shares in a company and claims to its future cash flows and profits, whereas debt comes in the form of bond issues or loans, while equity may come in the form of a common stock, preferred stock, or retained earnings. The short-term debt is also considered to be the part of capital structure. It means mainly under capital structure the two part, debt and equity. Under equity, common stock or the preferred stock, preference stock means equity shares, the preference shares, and retaining retained earnings. These are the three parts of the equity shares or under equity. Whereas under debt, the short-term debts, the debentures, bonds, and loans. So these are covered under the debt. It's a capital structure. The capital structure includes mainly two parts, debt and equity. And then equity include contains, or the elements of the equities are common stock, preference shares, retained earnings. Whereas under debt, the elements are debentures, bonds, or any loans. So this again it dependent on the company. Whenever the debt is less, it's good for the company. If ideal debt equity ratio is 2:1, and if they maintain it, it is a good. Always whenever the debt is less, then it is a very good for the companies. It does not mean that there must be debt. Of course, company may have the debt. They will, every capital structure have the debt and equity, but it should not be more than the uh, ratio of the equity, or the they have to maintain that proportion. And capital structure is how a company funds its overall operations and growth. So that shows how the company provide the funding for its overall operations, for all the business activities and for the development. That shows the capital structure, shows that how the funds are utilized by the company. Debt consists of borrowed money that is due back to the lender, commonly with the interest expense. Already I told the debt consists of debenture, bonds, or the loan, the borrowed money, these all. The debt consists of borrowed money and which has to be paid with the interest, and it is a part of expenses. Interest is expenses for the company. Then equity consists of ownership rights, like a company ownership rights in the company without the need to pay back any investment. So that is dependent on that particular return, paying back or redemption is dependent on that particular shareholder or the owner. The debt to equity ratio is useful in determining the riskiness of a company's borrowing practices. The debt equity ratio is useful in determining the riskiness. It will calculate the riskiness of the risk factor of a company in borrowing practices, companies borrowing practices. So that is, so they have to maintain the ideal ideal debt equity ratio. Every company they will follow it, they will try to maintain it, otherwise they will try to at least reduce the debt. Means that shows there is a good operations or good financial activity or good business activities, and there also the growth in the company. So that's called as a capital structure. So capital structure is the combination of debt and equity of a company, which will shows the overall operations and the growth of the company. The ideal debt equity ratio is 2 is to 1, or the ideal capital structure or optimum capital structure should be in the ratio of 2 is to 1. It is not mandatory there must be debt or there must be debenture or the bond. That is left to the company. It dependent on the performance of the company. So that's all about the capital structure. The importance of capital structure or significance of capital structure for a particular company. The first one is a value maximization. The capital structure maximizes the market value of a firm. So it will increase the market value of the firm. How? In a firm having a properly designed capital structure, the aggregate value of the claims and ownership interest of the shareholders are maximized. So whenever a company maintains the optimum capital structure, definitely the market value of such company will increase. So the ideal capital structure or optimum capital structure will increase or it will maximize the market value of the company. Next, cost minimization. The capital structure minimizes the firm's cost of capital, means cost of return on capital or cost of financing. The capital structure will reduce the firm's return on capital. How? By maintaining that ideal ratio or a good capital structure, means a good relationship between the debt and equity, good ratio or proportion between the debt and equity. So through that they can reduce the return on capital. It's the main part which will influence on the profitability of the company. The cost of capital, if it is increases, then the profitability will reduce. So if they maintain the lower cost of capital, then their profitability will increase. So by determining the proper mix of fund sources, a firm can keep the overall cost of capital to the lowest. So whenever the weighted average overall cost of capital means weighted average cost of capital, whenever it reduces, whenever they maintain it to the lowest, then profitability will increase. So how to maintain it? By maintaining the proper mix of fund sources. Proper mix of fund sources means by maintaining proper capital structure. Fund sources are debt and equity. So by maintaining good mixture between the debt and equity, so they can reduce the overall cost of the capital. Next is increase in share prices. The capital structure maximizes the company's market price of a share by increasing the earning per share of the ordinary shareholders. So in first point says it will increase the value, market value of the company. So means market value of the equity shares. So whenever the market value of the equity shares increases, then the earnings per share will also increase, and that is benefits for the equity shareholders. So it at the same time it will also increases the dividends to the shareholders. So there is a lot of benefits to the owners or to the equity shareholders whenever they maintain optimum capital structure. So another importance of a good capital structure is increase in share price. Next, investment opportunity. The capital structure will also increases the ability of a company to find new wealth, creating new investment opportunities. So it will also help the company to make new investment, to start new project, or to expand their business. So start the new business, start the new product. So in that case, so to create the new investment opportunities, the capital structure will help the companies. With the proper capital gearing, it also increases the confidence of the suppliers of debt. So whenever the company have the good value in the market, whenever earning per share increases, and ratio between debt equity ratio is a minimum, then for to such company there are a lot of suppliers who provide the funding facility, who make the funding facilities. Even the investors do the investment on such type of company, so the company can easily start a new investment, or they can diversify their business to other sectors also. They can create new investment opportunities whenever there is a good trend or good value for their securities in the stock market. So that is another advantage of a good capital structure. Next is the growth of the country. So good capital structure will also help for the growth of the country. Capital structure increases the country's rate of investment and growth by increasing the firm's opportunity to engage in future wealth creating investment. See, if any company's market value is increasing, and if there is a optimum capital structure, and if the debt equity ratio is the lowest, if they maintain it, and if there is a minimum cost of capital, definitely investors are going to invest on the shares of that particular company. So whenever there is, it means the percentage of investment will increase in a particular country. So that the source of revenue for the from the investment will also increase in a particular country, so it will also contribute for the growth of the country. Next is a pattern of capital structure. So again, it's also important in case of patterns of capital structure. There are usually two sources of funds used by a firm. One is a debt and another is a equity. A new company cannot collect sufficient funds as per their requirement, as it has yet to establish its credit worthiness in the market. Consequently, they have to dependent on only on equity shares, which is simple type of capital structure. After establishing creditworthiness in the market, its capital structure gradually becomes complex. So for the new company, their main part of capital structure is only the equity. With the major part is equity. That generally the debt will be less because the suppliers, less number of suppliers, less number of finance providers. So generally they will create the capital structure with the help of equity only for the safer side. And once if they establishes a good credit worthiness in the market, generally then consequently they have to dependent only on equity shares, and which is generally called as a simple capital structure. But uh, establishing the credit worthiness in the market and its capital structure, whenever they try to maintain, or whenever they plan to create good credit worthiness, or to establish good credit worthiness in the market, then capital structure will become a complex process in the uh, for a particular company. That will become complex whenever they try to establish good credit worthiness in the market. In the beginning it will be simple because there it consists only equity, no debt. But later they want to create credit worthiness in the market. Whenever they enter into the market, then their capital structure becomes complex, means they have to add even debt also. So this is the sixth importance of a capital structure. That's a pattern of capital structure. Means pattern of capital structure, in the beginning it is easy, but in the later stage it will become complex because of increase in case of business, expansion of the business, increase in case of credit worthiness in the market. The automatically the capital structure will become complex process. Next is maximization of return. The capital structure plays an efficient role in maximizing the overall return of the company. So it will also contribute for the overall to increase the overall return of the company. How? By maintaining the minimum cost of capital. A properly designed capital structure raises the earning per share. A sound or optimum capital structure will always increases the earning per share, and which ultimately maximizes the overall return of equity shareholders. So a well built or well designed capital structure will always increases the earning per share, and it is a plus point for the equity shareholder. So it maximizes the return. So capital structure will also require, or it plays significant role in case of maximizing the return. Next is a minimizes the financial risk. Even the capital structure plays significant role to reduce the minimum financial risk, or to reduce the financial risk, or to maintain the minimum financial risk. Every business aims to minimize the overall financial risk involved in its operations. The main problem for the main risk for every company is the financial risk. Then they will always try to maintain it, or they will always try to control the financial risk. Whenever it is out of control, then the company find it very difficult to take it back, or reduce that particular financial risk. So they will always try to control the financial risk, because it will impact positively on the capital structure of the particular company. So capital structure decision assist managers in attaining a balanced proportion of debt and equity, so that results in reducing the risk. So whenever they reduce the financial risk, definitely cost of capital will reduce, or they will get good return, means good return to the shareholders. So everything will be in positive side. Next is enhances firm value. It increases the firm's or company's value. Every investors prefer to invest in such companies which have a good capital structure. In the beginning itself I told, a investor generally find out the company which have the good capital structure. As an investor, you and me, we always take the decision of buying this particular security, or we are ready to invest on a company which have the good capital structure, because it is our amount. We always analyze the risk, and we are not ready to take highest risk, and we are not ready to lose the investment amount, or we are not ready to lose our capital. So we go for the investment on a company which have good design of the capital structure, or which maintain the ideal capital, which maintain lower debt equity ratio or ideal debt equity ratio. So therefore, so company always try to maintain the good capital structure, because to attract the investors. So proper capital structure increases the market price of companies shares and security, which in turn raises the firm's value. So always they will maintain the good capital structure, because that will increase the market price of shares in the stock market, and at the end it will increases the value of the company. So again, the capital structure, a good capital structure or optimum capital structure, will enhance the firm's value. So these are the the next point is provides flexibility. The capital structure provides flexibility in adjusting debt capital as per the business conditions. Provides flexibility, the adjustment in case between debt and equity. So it should be there in case of capital structure. So it will always provides adjustment between the debt and equity in their capital structure. The next one is the efficient utilization of funds. The capital structure pays attention on fuller utilization of available funds. So it will gives the attention on fuller utilization of available funds. So efficient utilization of funds. So whenever they have the sufficient whenever they borrow whenever it includes debt in their capital structure, it should be utilized to the optimum to the best manner. So all debt which has been, or the fund which has been borrowed in the form of debt, to be utilized properly for their requirements, so through that they can get good return. So that is called as a better utilization of funds. The fund which has been raised either through equity or to the debt, to be utilized properly. Next is a tax planning tool. Capital Structure Act, a planning tool for deciding the tax liability of the company. Even it will it is required at the time of calculation of the tax slab to find out the tax liability of the company. It provides a tax deduction facility for firms opting debt funds, thereby enable them in saving their profits and reducing the cost of borrowing. So generally the tax deduction facility for the firms which opting debt funds, so generally the company which opt the debt funds, for them there is a tax deduction, but again should not be crossed the limit. So through that they can enables them in saving their profits. So they can instead of paying the amount, instead of paying the profits as tax to the tax, they can enable it, they can shift it, and by reducing the cost of borrowing. So these are the different significance or the importance of designing a good capital structure. So capital structure plays a major role for each companies, not only for the MNCs, even if for the any partnership firm, or even in case of a sole trader also there is a capital. So it plays major, capital structure is there in each and every business unit, they have to maintain it properly. So because that is that which will decide the success or failure of the company. So that's all about the significance or the importance of capital structure. Thank you very much.